Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good day, everyone. How you going? Thanks for joining us on the Smart Property Investment Show. It's Q&A day. We typically try and get around to doing this every month or so. We probably should do it more than what we do. We've got questions stacking up from people writing into us at editor@smartpropertyinvestment.com.au. Just everything about the podcasts that we do. So we try and get around to them. So keep the questions coming. We do enjoy them and we do get to a period where we can actually respond to them, but I'm not the guy to do that. What I typically do is try and find people from across the property establishment, the property ecosystem that come on the show who know a lot more about this than what I know. And today I've invited Scott O'Neill into the studio. He's the director of Rethink Investing. It's not the first time he's been here. He's been on a number of podcasts beforehand, but I've been able to jag him off probably QF2. He's been over in Europe for the last 3 or 4 months or something, looking around, and I think we're doing a bit of relaxing, but also recharging and rethinking his business. Scott, how you going, mate? You well?
Very good, mate. Thanks for having me.
So Europe, a big fan of travelling there. Has it been a good couple of months out there?
Yeah, the wife is, spent 8 years of her life in Greece, so it's always a good excuse to go over there, pit stop in Greece, and then try to do a few new countries every year. So this year will be no different. Hopefully get away.
It's pretty good.
Yeah, just always trying to look at new places in the world and just live life.
Are you a good traveller? I'm a bad traveller, but are you a good traveller? You enjoy it, you get around and make an effort?
You get a little bit over looking at cathedrals and statues because they're all the same every country. So I like getting involved in like the culture a little bit more, not just getting on the bus and doing the lap. So I'm not bad, just the flights, feeling the bones ache a little bit more than they used to, which is a worry. A highlight from the most recent trip. I know you've always got your business in the back of your mind. I know you guys are grinding ahead, but highlight from the last trip out to Europe, anything particular you liked? Probably Scotland.
Okay.
Just because I had no expectations. I like the beach, the sun, and went up there middle of summer and it was freezing and miserable. Like in the middle of summer, it was about 13 degrees. So. But it was just amazing countryside and never seen anything like it. I think they've done hundreds of movies in that, at the north side of Scotland, and you could tell it felt like being in a movie.
It's just raw and rugged and authentic, isn't it?
Windy and miserable.
And the Scots are good people. Yeah, they're good fun.
Yeah. They're rough. Everything's a joke and hard to understand, but they get along with Australians.
Did you run into many Scots when you were there? Did you sort of have a chat with them in their local pubs and stuff?
Yeah, they approach you. It's like they're just really friendly and they just love a yarn and really good little experience, that one.
Did they ask what you do? They go, what do you do back in Australia?
I don't really say too
much.
You
don't say much?
Yeah.
I work in property?
Yeah, they wouldn't understand. I think we just pretend we're on a couple of week holiday and, as soon as you start just saying you're here for 3 months, they don't really understand it too much, and that's it.
Well, I was hoping you were going to give me a good segue about how property in Scotland's exactly the same as what it is in Australia, because
there's no balconies in Scotland.
There's no balconies in Scotland, is there? It's very different property markets, but I think the Scots are just as passionate as what us Aussies are around property. Everyone wants a home to live in, or they're looking to create value or wealth through property, which is essentially the game that we're in around property investment. It's and we haven't actually got any questions today which talk about the difference of Scottish and Australian markets, but these are hot off the press. The team give these to me, so if you listen to one of these podcasts before around Q&As, we like to be really raw on them. So we've got a stack of questions in front of us. We're going to try and grind through them over the next sort of 20 or so minutes, hopefully to give you some insights. Quick preamble, disclaimer, if you want to call it that. We're just going to have a chat about this. There's no particular recommendations or advice in any of our comments around these things. We're just having a bit of a chat around it and hopefully get you thinking about these type of issues or concerns and how it might fit within your portfolio. So I've got 3 really good questions here. We normally get a few more, but I think we can probably get into these pretty well and everything's sort of on record here, and we'll push Scott to sort of get his findings on it. But the first question, Scott, is from Bud Bradford. So Bud, how you going? Thanks for writing in, and your question here is an interesting one. I think you've just listened to a podcast that we've recorded and just sort of banged out an email to us, and we've struck some sort of emotive chord with you. I'll read it out and getting how it is. Bud writes, so what was that podcast all about? Clear as mud, a couple of blokes having a bit of a Tanti about the Royal Commission recommendations regarding mortgage broker fees, or was it? ? It seemed vaguely like you were trying to say mortgage brokers would be going out of business if fees of service were enforced. I'm an investor and wouldn't mind paying a mortgage broker if it was all upfront like a buyer's agent's fee. It's part of buying cost. Can you please spell out to listeners why they will be going out of business? Spell it out for the truckers amongst us. So, Bud, I get where you're going from. So I remember this particular podcast, and we're having a conversation. It was right at the point of time before the Royal Commission, or maybe just subsequent to the Royal Commission findings being handed down. And those recommendations at that point of time, and we're talking about 5 weeks ago now, was that brokers shouldn't be paid a trailing commission or an upfront fee. They should be paid by the borrower to secure the mortgage. Now, things have moved on a lot since then, Scott. Where we are today, and some of the readings I've been having around the different commentary was that they're not going to get rid of upfront commissions. It might change a little bit. And even now they're talking about trailing commissions remaining because of it keeps a broker highly connected and in with their client. Your views, we've moved on a lot since Royal Commission. I know you've been in Europe, but you've been keeping abreast of all this stuff. What's your read of it all now in terms of the value that mortgage brokers are applying for property investors?
Well, as you said, since that last podcast, a lot's changed. So I believe Liberal has actually said they're going to actually leave it as it is. That's quite new. Upfront payments would not be good for the industry because there's been some surveys done that 95% of people would go direct to the banks to avoid that. So some would. I would personally go to a broker because I don't have the time to knock on 4 different banks' doors. It's not worth it. But I'm not the masses. So it would have been terrible for the industry. It's good to see some of these recommendations get lifted because it would have given more competitive advantage back to the banks, which is not what we want because that could lead to higher interest rates long term. You need someone working for you to shop around for the best deal. A bank, if you go to them direct, they're going to show you their set of rules, which is not going to be the best deal because there's dozens of other options out there in the market.
Yeah, I completely agree with you. Number one, I've been vocal about this on this podcast, is I couldn't think about going to a bank branch as a property investor to say, Mr. Bank manager, I'd like another loan. And they say, okay, can you give me the statements from every other property you've got? That's the role of a mortgage broker, and I've got a good mortgage broker that does that for me. But things have moved on a lot, as you said, Scott, and where we are right now and coming out today was that the Liberal government have said that they're quite happy with the current remuneration structure, which keeps the broker connected in with the consumer for the long term. But to your point, Scott, you don't get the best deal. Potentially, you don't get the best deal if you go directly to a bank because you're only dealing with maybe 1 or 2 products versus going to a mortgage broker which has multiple products, and they're going to be able to assess at any given time your ability to secure financing as a property investor based on your circumstances, situations, or where you're choosing to invest. So that's a really important point. What I would say, Scott, with this particular question, and it might not become clear really quickly, but I think Bug gets it, is that he's saying he'd be happy to pay for advice around securing the best mortgage, even if the broker remuneration changed. So I think the good thing is that you're probably not going to have to pay moving forward. I think it's going to stay similar to how it is right now. But I think Bud's representative of more sophisticated investors who are happy to pay for the advice to help them be better property investors, which is very much what a buyer's agent does, right? Correct.
And most of your listeners would fit that category. So you're not the average cross-section of the community. Most people still, have a family, Westpac manager that they deal with. And you're right, it excludes you from the rest of the market. And particularly for people with larger portfolios, like myself, I've got things like unit blocks, normal houses, commercial property. For me to go into a branch to go through all that with some person who's never met me would be an absolute nightmare. I'd probably get knocked back, and then I'd have to go and do it all over again at CommBank, and then go to NAB, and then I would be wasting my whole day with no result. A good mortgage broker has connections within the banks. They can speak it to people at different levels, the right levels, and results happen quicker, get me better interest rates. And, if we need to move down the track, we can, because the mortgage broker will understand my situation and it just fast tracks everything.
So you've been in the buyer's agency space for a while, Scott. This mindset or objection that people might have to pay professionals a fee to get the job done, to actually get the advice they need to, whether it's mortgage brokering or whether it's accounting or whether it's being a buyer's agent, sophisticated investors don't focus on the fee to get good quality advice. They think about the fee and what the fee enables them to get in terms of how to be a better property investor. That's a good way to see the world.
Exactly. Everything should be a business decision with money. If a buyer's agent, you might get charged 10 grand. They need to make you more than $10,000 plus save you more time. It needs to be a good transaction. I'm actually finding since I started, like I've been running Rethink Investing for about 5 years now, people are a lot more inclined to spend for a service in this industry. The do-it-yourself attitude worked when you're buying in your local backyard. A Sydney guy knows his suburbs. But what about now when you've got to buy outside Sydney? It's like a stockbroker. You've got to go out, take good advice. If I buy stocks, I use a stockbroker because I'm not going to waste hour after hour researching company P&Ls to try and pick a gap in the market. Hopefully someone that does that 12 hours a day, 5 days a week is going to pick it for me. I'll have to pay like a little percentage at the start. It's a no-brainer.
And it's good. I find it quite reassuring. We've been doing this podcast for 3 or so years now, and a big sort of rhetoric or mantra that we have is that you need to understand and appreciate as a property investor what good quality advice entails. And my point of view would be is that if you're not paying for advice, you need to question the quality of that advice. And a lot of people get this wrong. They think that a buyer's agent is operating in their best endeavours because they've recommended an off-the-plan purchase. I'm not saying there's anything wrong with off-plan purchase, but they go, oh, hang on a second, I found a really good property for you, but it's not going to cost you anything. You don't need to pay a cent because I think it's really good for you, but someone's getting kickback from a developer. So you need to question the quality of advice. And I think this goes back to Bud's question, is that he'd be happy to pay for a mortgage broker if he's getting good advice. But as a sophisticated property investor, you need to make sure that the advice you're getting is in your best interest, and not all advice is created equal, is it?
No, exactly right.
It's good. So I hope that helps. But we've been covering a little bit off this Royal Commission recommendations and findings, and it's a bit of a moving beast. From the first couple of podcasts we've done around it, when it was more of a, oh shit, what's happening and what's all this mean to us? We've sort of been ticking off and covering it off over a period of time. And check out smartpropertyinvestment.com.au because we can look at this daily, the changes in attitude and behaviours and recommendations coming out of both the sitting government, the coalition government, but also potentially the new government that may come into play when we get to an election later this year in a couple of months. They've both softened a lot on their attitude towards mortgage broker remuneration. And I think sensibility has prevailed within our corridors of power, whether it's the sitting government or whether it's the government that may come into play, around the value created by mortgage brokers in keeping competition in this market, and the fact that mortgage brokers represent the consumer and assumes a better consumer outcome. So we'll keep covering it off, Bud, but go and have a look. If you want to get in touch with us and ask some more questions, I'm happy to respond to them, or if it's outside of my capabilities, editor at smartpropertyinvestment.com. I'll make sure I get someone to respond them for you, but thank you very much for your question. All right, Scott, the next question is around, I guess you'd call it diversification. It's from a guy called Craig Rayner. Craig, thanks for writing into us. I do appreciate it. And I'll paraphrase. It's quite a long question, but I get the crux of it. Craig, and I'm just trying to work out how I can do this really quickly reading it, but in essence, Craig's concerned about Sydney and Melbourne markets in terms of residential real estate, and he's running as a property investor. And he says here that he's got 3 properties right now. Should he be considering other asset classes, including commercial property, rather than residential property in these markets right now? So it's a diversification play. Is commercial markets good to move into right now? I guess the crux of the question, Scott.
Yeah, and this is a common question I get with my clients almost daily. It almost started probably when Sydney and Melbourne started falling down in terms of price. So that was 2017, July, the market was slowing down. It almost gave people the picture that the guaranteed growth for residential wasn't going to be there forever. So naturally you look for alternatives. The share market sort of was going up and down at the time, and the yields people were buying into for so long into Sydney and Melbourne were at record lows. So if they've made equity, even if it's coming down, they're going to naturally look to use that equity to create more cash flow. So it was almost a default. I think it's a default move, diversify into a market with better cash flow. Don't buy into Sydney, buy into another market to diversify just for location as well. But commercial is becoming extremely popular, and I'm actually hearing that through agents I talk to. There's not much stock out there, so when one comes up with a tenant, it's just it's a frenzy.
Yeah.
Commercial. So particularly the sub $1 million range. And even when you go up into the 2s and 3s, if there's a good lease in it, national tenant, those things are a good quality property doesn't last more than 30 days on the market, which you compare that to most residential markets at the moment, it's twice as fast.
So what do these assets look like? Are they just a corner store with a flat on top of it, or this sort of sub $1 million mark? What's really attractive in a commercial play?
Sub $1 million is anything from large warehouses, and you can get multiple shops. You can get medical for that price under. You're normally working with 3 to 5 year leases. We personally only buy stuff with 7% net returns or better, so the tenant pays all the outgoing. The risers are built into the lease of around about 3 to 4% per annum. So that, in a way, that's going to be giving you equity of 3 to 4% growth on your property each year, which is lovely at the moment with prices not going down, or going down in many markets. So if you can make good cash flow and some growth just through rent rises, you're looking pretty good. So a lot of people are turning to it, and I personally love property. I plan to buy around sort of 2 million myself in the next 12 months in commercial. I'm not buying any residential. I've got enough. The cash flow of maintenance, it's just not exactly what I need at this stage in my personal journey. But residential was the reason I got here in the first place. So you can never forget that side, but diversify into it later is a good option for cash flow.
So the people you're working with, and I'll run on from this question from Craig, are people moving into commercial because they have a significant or substantial residential portfolio? So this is a cash flow play for them? Is that pretty much how it's falling into sort of portfolio build for most?
A bit of both. So I've got some first-time buyers buying commercial.
Straight into commercial? Straight
into it. So they tend to be business-minded people on good incomes. If you go buy a $300,000 property, you're going to have to put 90 grand down plus the stamp duty. So you're still looking at a 6-figure deposit for a property, quite a cheap one. But the people that can afford that and they understand business, see the opportunity, if you buy a few of those and half pay them off, that's an incredible passive income you've got. You can quickly create a $50,000 passive income, which to a lot of people is a great head start for retirement. The strategy of just buying, half a dozen residential properties, evenly gear it for 10 years is another way of doing it. But the income won't really come from that. So at some point, you're either got to pay debt off quite substantially, or you move into stuff like this with the equity you've created. So, to answer your question, it is mostly people with portfolios with an income behind them, and they just can create passive income is quite large from this, and they understand the risks and the rewards, and they tend to not really go back to residential. Once they go into the commercial space, they stay.
So what's the trigger point then for someone who is traditionally a resi investor? What's that light bulb moment when they go, hang on a second, this commercial thing sounds all right. What draws them to it? Is it the yield? Is it the potential for capital growth? Is there anything in particular?
Heaps of different reasons.
Or good education maybe might help.
Yeah, understanding it's a big one. So a lot of my clients who buy commercial properties are tradies that rent a place out. So they've understand a lease cycle. They understand that when you lease a place, you look after it. You pay the outgoings as a tenant because your business is there, your livelihood's there. They see that and they go, I don't want to deal with a tenant in residential who will trash my house, once every 3 years potentially, and I've got no control of them. It's a little bit less predictable, I think. If commercial with the right properties, it's quite stable, quite predictable. Things can go wrong if you buy the wrong asset. For example, if the rent's too high per square metre and you get suckered into the sale, that could hurt because you're going to have to release it at a lower price. You're going to lose equity. Once you know the triggers and, a buyer's agent will help you through all that, it takes a lot of that risk out. And I think people are more comfortable, in my circles at least, because I'm helping them get into it. And, there's a lot of opportunity to create equity through commercial too. So once people understand that you can make a commercial property on a longer lease go up in value, or you increase the rent, there might be some land next to it. You might be in a growth corridor. Yield compression might happen because people pay more for the same rent on the sale price. You still can get that equity. So people are probably seeing this more so because a few years ago, it was all Sydney and Melbourne. You'd be mad not to buy it. The market's growing at double-digit growth rates. Yeah. Why would you look anywhere else? Now those days are over. I think Sydney in particular is going to be flat for quite a while. It might bottom out next year, some say. But what will push Sydney up 30, 40% quickly after that? What growth drivers are out there? I can't see any. There's no income growth. Still a lot of stock on the market. So why would you go buy a 3% gross yielding property with $1 million debt? It doesn't make much sense. So people are looking for alternatives.
So if you're looking at the commercial space, you've painted a pretty bleak picture about the city market moving forward, and every market moves in cycles, and cycles can be 5 years, 10 years, 15 years. It depends where you are. Sydney's moving through a cycle right now, so it's just business as usual for Sydney. And we speak about this a lot on the podcast. But commercial assets, they are different. Their behaviours are different. The way in which they're valued are different. The way in which you generate income from them are different. And for example, you're talking about the actual tenant pays the outgoings rather than the actual owner or resi property. So it's very, very different. But if you're going to look at the commercial market right now, where would you be spending your money? What? So you're talking about these sub-$1 million assets, but where do you find them, and what should you be looking for?
I'll just use my example. I'm buying a property through my super fund, and the only thing I want just for a long-term investment, for me personally, because it will give me diversity, is an industrial warehouse. I like the idea that it's low maintenance. In 30 years' time, people are still going to need storage. There's an e-commerce boom at the moment. It's a simple construction that can lead itself to a million different types of tenants. You can have, a car mechanic in there. You can have, a showroom for, there's 1,000 different trades that need it. Commercial kitchens are often located in these places. If you lose a tenant, it's actually quite predictable how long it is to find a new one, because you can go on RP data and look at first listing date for a lease to first filled. So all you've got to do is check, like let's say you're buying a 200 square metre property. What are all the other 200 square metre size properties taking to lease out? Like, is it 3 months? You can check that date on RP data. If it averages out at 2 or 3 months, I'm comfortable with that, because most tenants give you 6 months notice when they vacate.
How do you go about and looking at commercial, and I rent commercial space, or I guess it's office space, but normally the owner at a point in time of a lease being determined or established needs to contribute to a fit out or whatever it is, some sort of incentive, because as an investor, you like try and keep the base rent high per square metre. You try and incentivise it in another way, and also lending and all that, which is probably a podcast for another time. But do you actually contribute to supporting, sustaining and creating stickier tenants by contributing to a fit out? Is that something you do?
Very rarely.
Okay.
But it depends who you're dealing with. If you buy a Coles, for instance, at the end of their term, they know their Coles. So they're going to negotiate the hell out of your lease. So yeah. I actually sometimes don't like buying those perfect tenants, because they know they're global. If you lose them as a tenant, you lose value in your property. So we buy a lot of properties. It might be anchored by, say, like an IGA. And then you've got a little dentist, a hairdresser, a Thai restaurant. Those guys tend to be a lot more sticky to the location. They're not as in a powerful position to negotiate. As long as they're paying market rent, you've got to look at it from a business decision again. Will they want to move everything they've got down the road because the rent's 5% cheaper? Probably not. Sometimes we've seen it where the rents have gone up 5% per annum for 10 years, and all of a sudden they're paying way too much. So then you can ratchet it back to the right price. But it's all about long-term value. If you can get a tenant in there paying a good rate on your property, and you make them sticky and you get a longer lease. So instead of a 3-year lease, I want you to sign a 7-year lease, and I'll give you a free month rent every year, for instance.
So you use an incentive like rent-free periods rather than contribution to a fit out or something.
That's better for valuations.
Yeah. Okay. And it's all about the valuation and how a bank chooses to view your asset, and it's quite a complicated scenario. And if you're not familiar or used to commercial real estate, it can be a bit bewildering. But if you want us to talk more about this stuff, we're happy to do so. And as more people shift towards commercial opportunities in line with changes in resi markets, we can cover this off if you like it. I know plenty of people that can come and have a chat to us about it. Just email us at editor@smartpropertyinvestment.com. But I'm going to move on for the last question, and we're sort of quickly burning through time. But I've specifically curated these, Scott, because I know that the particular way that you provide your services to clients. So there's a question here from Gillian Sullybank, which appealed to me, which I thought you might be well versed to answer. And Gillian, it pretty much asks about the change in the government moving forward. So we all know there's a federal election on the way. We've got a budget coming down in April, and then the election in May. We may have a new sitting government before the end of this financial year. Gillian's asking around, do I need to quickly hurry up and change my tactic around investing in property in my self-managed super fund, because the government, if it changes, might change the rules around it. What's your views on this?
Look, you never go make a decision off the bat of, and a guess. Right now, we don't know who's actually going to be in power. Like, there's strong opinions, of course, but you don't go make a big investment decision, off these types of things. You need just to wait it out, see what happens. So the two big ones I'm seeing, look, negative gearing, we don't really get into too much of that because we positively gear. I don't think you should invest for that strategy. It's not a wise strategy to buy a property just so you can get some tax back.
Well, a lot of people say investing negative gearing is not a strategy. It's a tax outcome, right?
Exactly.
I know you've said that a lot over the years, and a lot of people confuse the things.
Yeah, and like another big one is self-managed super funds. Labor said they won't be allowing you to lend anymore. So currently you can go out and lend to buy a commercial or residential property, or shares, in fact. So under Labor, that won't be happening. Will that actually get through the upper house and eventuate? We don't know. But if a lot of sort of experts out there are saying this could be something for mid-2020. So a lot of people are rushing to use their super to buy a property because it may not be there later. And it is a really good strategy when you buy the right property, because you can leverage. The whole point of property investing in Australia is to leverage.
Yeah.
So you wouldn't go it's just not an efficient way to go buy a property whole, because you're using all your money for a lot less asset value. So does that mean you go out and rush and buy a commercial property in your super fund? No, but it definitely means you should start talking to your financial planners, your experts around you, to find out what options you do have, because it would be nice to use it if you can, right now, if you can do it. I'm in that position. I was very lazy with my super fund, and just hearing these rumours maybe just start the process of setting it up, and I'm going to buy a property with it. I'm going to, like I said, I'm going to go for an industrial style property that I can just forget about for 30 years. So I think people should definitely be aware of what could come. And yeah, there's another one which is concerning, is Labor's 25% discount on capital gains tax, not 50%. So does that mean you go quickly sell your property right now because you're going to pay less tax? Again, you don't make decisions like that. But be aware of the changes that could come through. If you've got properties that have had good gains and you need to sell it, again, talk to the right people around you. You just got to put it in context what could happen. And, they're big changes coming up.
Yeah.
And yeah, you've got to plan accordingly.
Well, to bookend the chat, and our first conversation from Bud Bradford talking about, some conversation we had on the Smart Property Investment Show around changes in the Mortgage Broker Commission, and he'd be happy to pay a fee. From when we had that conversation to where we are today, are two very different circumstances coming out of both the currency in the government, the coalition government and Labor government rhetoric around those recommendations around the Royal Commission. Things happen quickly in politics, and things can change very, very quickly. So what you vote for today, and this is completely apolitical, I don't have a particular preference in the political party sitting in a seat in Canberra, but whoever's saying what they're saying right now when it comes running up to this federal election, and what will happen subsequent to that, whatever they believe in and whatever their rhetoric is, to actually get it through the parliamentary process of turning recommendations or policy into a law is a very, very different thing. So things do get stuck, things do change, and there's a lot of things you can't control, and this is one of those things you really can't control. But to Scott's point of view, don't feel as though you need to move quickly, swiftly, or without any sense of balance on the basis that things might change. Don't sell your property because you think you might not get a 50% discount on your capital gains. You need some pretty sophisticated financial advice around that. I'm not the guy to give it to you, but guys like Scott and accountants, financial planners, people that work in that space who are licensed to do so in a respective area are so. So, Scott, your overall view, your attitude towards property, it's always a good time to invest in property, is it, to round us out with?
Yeah, different markets. Like, you look at Sydney, since 2012, it's grown 83%. It's backwards about 14%.
It's a good bet, isn't it?
It's a good bet.
Yeah.
And if you look back at all the crashes in history, there's been almost triple to quadruple the growth before the correction. So, buy for the long term, make sure you've got the cash flow to support yourself, and just pick good markets. Where's the infrastructure going? Where are the people moving to? Where's there a lack of supply? What commercial related, what types of businesses will do well with changes in technology? You buy into that. Now's a really good time because you've got less competition. So many people are waiting for this election, and right now people still need to sell. So get in when there's less competition. If you wait till when everyone else is there, you've already lost out.
Sage counsel. The best time to invest in property sometimes is when everyone else doesn't want to invest in property. So I'm not giving you any particular recommendation now. I'm just giving you my thoughts on it. And just to reiterate an earlier comment around providing financial advice, and we're not doing that whatsoever. This is just really a general conversation to help you shape the way in which you view other markets. But it's good to have people on like Scott who know about these things, and I quite like your bent towards commercial, and I've been watching this evolve over a couple of years, and you're very passionate about the commercial space right now, and I've watched your own skill set around this increase over those times. So I think it's a good conversation to have, and I think we should get you on here more often to talk about these things, mate.
Yeah, thanks, Phil.
That's when you're not sort of travelling Europe. Do you sort of drive, or are you a train traveller around Europe? Is it?
No,
how do you normally get around?
I love driving.
You like driving?
Yeah.
Driving Europe's cool, but
very little. They're all manuals over there, and they're crazy. Particularly the Greeks. My pet hate is they stop in the middle of the highway to talk to someone across the road, and nearly cause accidents. All the cars have...
Something quite nice about that, isn't it? The fact that they just go, life's not that fast that you can't stop and have a yarn on the motorway. But.
Exactly.
So what's on for... I know you're sort of big on when you're at work, you work hard and you drive ahead, and then when you switch off, you like to sort of get some time to recharge and readjust and realign. 2019, anything on the radar? You're going to sort of spend some time off and relax a bit? I know you're big on lifestyle, so what's up? What's happening?
Well, the plan was book last minute this year. Okay. So we're just going to probably wait till mid-June, see what's going on, and book somewhere we haven't been and just play it by ear. Zero plans.
Perfect. It's the way I like to do it. It's planning on holidays. You just want to relax. But anyway, Scott, that's Scott O'Neill. He's director of Rethink Investing. Really enjoyed it, mate. It's always good having you on and having a chat to us and informing us, educating us more around this commercial space in particular. So thank you very much.
Appreciate it, Phil.
No worries. Remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to our daily newsletter, so the first to know what's happening in property and property investment, smartpropertyinvestment.com.au/subscribe. If you're a social media person, check us out, Smart Property HQ, across all the social channels. You can keep a line and keep connected about what we're up to. Remember, any questions at all or any sort of further details you would like, editor at smartpropertyinvestment.com.au. Contact the team and we'll make sure we get in touch, and we'll do another Q&A session soon. Thanks for joining us. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.